I'm Ross Weiner. I'm moderating panel. I've got my own firm, Gemsco Capital. It's a private real estate investment and advisory platform focused primarily on commercial real estate equity and debt. Invest on behalf of family offices, high net worth, other funds, and joint venture partners. Do single assets, portfolios, securities. I'm also involved with a startup company called Acre Homes, where we're going to have Mike Schneider, CEO, was supposed to be here, but he can't make it today, so I'll fill in for him. And I'm working with them as kind of head of their capital raising effort for Acre Homes in single family rental space. And we have a panelist with us here today, Jiho Lee. I'll instead of giving it with Tishman Capital, I'll let everybody introduce themselves the way they like. Dino Christoforakis here, Jiho's with Tishman Capital, Dino with Vential Capital, and San Eng with Genfire and Skytian Capital. And I know I get all of San's emails about his deals and his Genfire. He's doing a lot of interesting stuff, not just in real estate that I'll tell you about. So I'll turn it over to you, Jiho.
Thanks, Ross. My name is Jiho Lee. I'm with Tishman Capital Partners, which is really the family office of the Tishman real estate family of New York, known for their real estate business over the past 125 years. Ross actually has been an advisor and friend of the firm for over 30 years with us. So I appreciate the opportunity here with Marty and Ross here. Our main business is really have been in real estate. We were traditionally a construction contractor builder. We've actually exited that business a little over 10 years ago, and we've since been focused on continuing our real estate owner, developer, manager role, as well as we added the family office function where we've been doing stocks and bonds, private equity, venture capital, investing in other funds or seeding platforms. And then lastly, in the past 5 years, we've been more of a special situation fund manager where we anchored our own investment vehicles and brought in some friends and family type of capital to do special situation projects, such as we did CMBS trading when the bond market blew up in March and April of 2020. And then 2 years ago, we launched a qualified opportunity zone fund program, with a tax advantage angle. But generally, we've been very active in all aspects of real estate.
Dino?
Very good. Hi, everyone. Good afternoon. Thanks for hanging out with us. No, it's late in the day. Name is Dino Christoforakis. Today, I'm with a capacity as a co-founder of an operating platform called Avani Residential. Avani is a single-family rental, build-to-rent.
Hello? No sound. We lost sound.
Okay, sorry.
You can't hear it online.
Okay.
Can you hear it
Dino,
now?
Yes, Dino, I think for about 10 seconds we lost you.
Okay. So yeah, I'm the co-founder of a build-to-rent single-family rental business. We're based down in the Southeast. We're ESG focused. We're building carbon neutral, net zero, high performance housing. So communities of 200-300 homes at a time, operating them the same way as a multifamily building, only instead of going vertical, we go horizontal. So super excited to be here and looking forward to the conversation.
Thanks, Dino. Sam, a little introduction.
Great, thanks. Dino, great seeing you. Marty, great seeing you again. Thank you for inviting me here. My name is San Eng. I run a company called Skytian Capital. We're now based out of Tampa, St. Pete. We do three things. We invest in primarily real estate and majority in stabilized multifamily here in Central Florida. We also do later stage technology investing. We're looking at actually buyout of $1 billion revenue Chinese prop tech / real estate related company right now as a special situations. And then the third thing we do is nonprofit education. So that's the big logo here, Genfire. We have a group. We have a community called Genfire, Generational Financial Independence, to help promote financial literacy and teach investing to the next generation.
Great. Thanks, Sam. Now this is, I think, the second, maybe the third or fourth real estate related panel today. So I apologize if some of this has been sort of covered. I know the first speaker talked about real estate apocalypse, which a lot of people have thrown around the term apocalypse to apply to real estate. Not everybody signs on to that formula. I can see why people are thinking that way. I mean, we talked last time we did a panel a couple months ago. We talked a lot about the cross currents that we see in the markets, and those are kind of continuing. I mean, you've got Federal Reserve still hiking rates and signaling even higher rates. You got a heavy inverted yield curve, the likes that we haven't really seen before. It's almost 100 basis point spread. Bank lending, we've had bank failures since the last time that we met. And, obviously positive leverage and loans in general are hard to achieve. And this impacts the real estate business, and everybody's aware of the refinancing cliff that is coming. But, you look around in the markets and still there's, a lot of liquidity, a lot of equity liquidity if you're not suffering from leverage. And, yesterday SL Green announced a big deal where they sold half of 245 Park for $1 billion at a $2 billion valuation. You had another deal announced yesterday where Prologis spent $3.1 billion to buy an industrial portfolio from Blackstone. That was at a 4% cap rate. The SL Green deal is reported at a 3% cap rate. Sounds like crazy numbers, right? But for SL Green, they're deleveraging. It seems like there was another component of the deal that wasn't well reported, where their partner was a Japanese company coming in, bought some of the debt that may protect them in the future from, foreclosure issues. So, those are sort of some of the positive things happening in real estate. And then you get a drumbeat of, negative reporting. Bloomberg article, the world's empty office buildings have become a dead time bomb. There's a senior housing company called Diversified Healthcare Trust that sees no path to refinance at $700 million in debt until at least mid-2024, which, their debt comes due much sooner, so they're selling the company. So, there's still positive activity and there's a lot of negative activity. So, one of the things I think that's worth exploring is, as the year has progressed to date, how have things gone versus your expectations, and what do you see for your own firms happening over the next, 6 months? Jiho, you want to take that?
Yeah, sure. So, beginning of this calendar year 2023, one theme we stuck by was there's going to be extended period of uncertainty. And I think we've been very much right about that call. Obviously, it's an easy call to make. How that uncertainty plays out has been a big question mark. As a result of that general sense of there's going to be extended period of uncertainty and volatility, we've been a little bit more sitting on the sidelines as opposed to actively, seeking deals, especially as a real estate operator and investor who has the option to also invest in stocks and bonds. We found actually more compelling risk reward opportunities outside of the real estate world, namely in the fixed income market, muni bonds, corporate credit, even some treasury plays. So as a result, for us, given the relative value in the liquid fixed income securities, going into less liquid real estate deals have been a little bigger of a challenge for us. We were hoping maybe something will change, some trigger event will, force sellers to kind of meet the buyers with the bid-ask spread tightening or whatnot. We are yet to see that. We haven't seen that. In fact, it's almost going potentially the other way, where even up until a couple weeks ago, the treasury market was pricing in some form of rate cuts, by the end of the year. As of 2 weeks ago, all of that is priced out, meaning no one's really expecting any rate cuts this calendar year, which is going to probably continue to force the bid-ask spread to stay until somebody who's really desperate has to make a move. So as a result, we're still sitting on the sidelines as it relates to real estate investments. We've been much more active in the fixed income world. And there's certain other things that I can talk about. What are we doing in real estate in preparation, as well as some opportunities?
Dino, how is the environment affecting you? I mean, you're blowing and going with new business opportunity in the build for rent space.
Yeah, so just to put everything into context, my career the past 20 years, I touched pretty much every major asset class, right? And I've worked for major LPs, pension funds, investment managers. So we're allocating capital into traditional asset classes for a long period of time, right? So my vantage point back before the crisis was the same that it is today, although a little bit exacerbated today, right? Because of everything that's going on around us and the interest rate environment. So there's been a couple of interesting fundamentals playing out that everything got accelerated when COVID first happened, right? So I think when it comes down to office, right, it's following the same or similar pattern as retail has followed over the past 10, 15 years, where we've reached a point where we're joking, between ourselves, and we're saying, retail is probably under demolished, right? I think we're reaching that point with office, where we see a lot of functionally obsolete buildings that they're going to need to get repositioned. The reason why I got out of what I was doing before and I got into the build to rent single family rental business is because I saw some long-term fundamentals trending that way that allowed me to have enough conviction to invest my own capital into something that has a long-term runway. So we're seeing very strong fundamentals on the U.S. housing sector on the supply and demand side, especially on demand. San is going to probably touch on that in a sec, but I know you agree with that viewpoint, but there is enough demand to satisfy whatever supply we have for the next 20 years, and if we keep the current pace of building housing, whether that's multi or single family, it's going to take us 18 to 20 years to catch up with the demand, and that's not going anywhere anytime soon, right? But at the same time, we'll have to realize as real estate operators, what are the main pain points that we've all identified over the past few years. And one of them is the supply chain hiccups. And the other is the labor shortage in the United States. So what we did to work around that with my group, we start innovating, right? So we're using off-site manufacturing essentially to build the major components of a house, not going crazy, building the entire house and then having to worry with other logistical nightmares. But we're building panels and then stacking them up on the back of a flatbed, shipping them on the side, and that allows us to be perfectly aligned cost-wise with a traditional way you build a house today. But at the same time, we can build the exterior and interior frame of a home within 5 days using a four-member crew. So we're cutting down on timing. We're cutting down on the different trades that need to build a house. We're reducing waste, which is a major component when it comes down to ESG. And at the end of the day, we're delivering a product that is rated for Category 5 winds, 200 miles an hour. Is completely carbon neutral because of the way we build it and minimizing waste and energy. And it's net zero because we're using solar panels at every home, and every home looks like and feels like a Yeti cooler essentially. So there's no thermal leakage coming in and out of the house.
Dino, where are you doing this, and how did you pick the locations?
We've launched in Florida. We have a factory in Florida manufacturing those panels. And we are going to be targeting the Sunbelt states. I know San is down in Tampa. We're down in Tampa as well. So next time I'm down there, I'm going to hit you up. And we're going to be rolling out. I mean, we have big plans. We're going to be rolling out pretty much throughout the Sunbelt over the next 5 years.
What's the price point that you're focused on?
Yeah, so on the community size, our sweet spot is between 200 and 300 homes. Average deal size about $100 million. Every home is probably worth around 250 to 300,000 bucks. It cost us that much. It's worth in the 400s. So we're underwriting on the community base, high teens IRRs with moderate leverage, with very slow rent growth, if any. In certain markets, we actually underwrite zero growth because some of them are a little bit saturated. So we try to go to the markets that we still see growth on the population, on the job creation side. But yeah, very conservative underwriting in general. I think that's the name of the game today. If I was writing checks, that would be one of the first things that I would be looking at.
Now you sound like a salesman.
Why not?
San, you've been doing multifamily value add, and I know that you've purchased some properties, fixed them up, and sold some of them. Are you still doing that? Have you held? Has your outlook changed?
Sure. I think this market rewards those that are creatively aggressive. I'm not sure if that's the best word, but I love what Jiho said. I agree with what he talked about in terms of macro. I don't see it improving overall. And there's still buyers. So we've been focused this year on exiting some of the assets that we're not looking to hold as long. So we just last week we sold a third asset. We've had to be a bit more creative. For one of them, for example, instead of selling it as a portfolio, we decided to slice them and sell them one by one. And we just sold the last one last month. And these are yielding fairly high IRRs. Each of those are netting LPs north of 45%. Just being a bit more creative in the exits. Like Jiho, we're not actively seeking deals, but we're extremely active. We are seeing some deals in the market. We went under contract for a 230 unit, $40+ million deal off market for 166 a door, Class B, 98% stabilized in a very nice income, $100,000 household income area. And we didn't look for it. It just so happens one of the major shareholders of this asset is a Chinese private equity fund that is selling the last of its many assets because of geopolitics. And so we were able to find our way in, take this off market. Actually, it's not a sale, it's a recap, which saves us on taxes. And so we're not chasing these, but we are beginning to see some interesting opportunities today that we wouldn't have seen, just a year and a half ago.
And I'd like to add some, also filling in for Mike Schneider, who's not here. Acre Homes business, which is a startup in the single family rental space focused on Raleigh, Durham, North Carolina, and other southeastern growth markets. We're providing a solution to would-be homeowners that only want to live in a home for 3 to 5 years. And the transaction costs make it so that it doesn't make sense for you to be a buyer. We're offering another solution where the buyers come to us and we say, look, we'll buy the home. You'll rent from us for 3 years. We'll give you a participant. You'll put up 5% of the capital required to buy the home. You'll get 10% of the upside of the home. You've got optionality. You can buy it down the road. Whatnot. We're getting about a 7.25% to 7.5% cap rate going in with no lease up risk. And it's differentiated from other single family rental companies that are buying lower quality homes with non-credit tenants. Our tenants are all credit tenants. And, it's a business that we think we can scale up, not just in Raleigh, Durham, but in places like Atlanta, Dallas, and other southeastern markets that have strong income and employment characteristics. And there's been a lot of activity in that space, which has been very encouraging this year. There have been a couple of deals that were just announced in the last month. Pretium Capital spent $1.5 billion to buy 4,000 rental homes from the largest home builder in the U.S., D.R. Horton, and at about $375,000 per home, and that's only half rented. Again, we don't have any vacancy. And there was another deal with a company called Sculptor that put up $100 million to help grow. I don't know, this company might be in your neck of the woods, Sam, called Second Avenue. It's a single family rental company. Have you heard of them?
I have not.
You've not, okay.
I have, yeah.
But there's been a lot of activity in that space there too. So, you know, from the capital side, we're seeing, you know, things earlier this year coming out of late last year were very tight in terms of raising debt and raising equity and looking for debt. And we've seen that, you know, loosen up a lot, and our fundraising has been going pretty well recently. The other business that, you know, I'm personally focused on for this year is along the lines of one of our other panelists, where they talked about the real estate private credit that Northwind that presented earlier. I'm involved in a business that's doing similar things, and we think that that's a good risk reward, you know, adjusted risk reward play to do New York, to do construction completion loans and condo inventory loans. You know, lenders are pretty much out of those markets and get very high yields, being at very low loan to values. And if you know, if you're comfortable with that kind of property and can underwrite it properly, it's a good place to be. How long that window will last, I don't know. You know, those loans tend to be short term, 12 months to 36 months. You know, if the lending markets stay tight, it'll be good business for a while. If they loosen up, that might change.
Sure.
So, but we are seeing, you know, more, you know, there's capital available for that. There's capital available for the single family rental homes. I mean, Dino's been successful in raising capital. Jiho's got tons of capital. He just doesn't want to spend it. Anyway, why don't you tell us what you are doing, Jiho?
Yeah, so in the real estate world specifically, you know, as a family office, first and foremost, we're very tax sensitive, as I'm sure a lot of you in this room would be. And real estate has always been one of the, you know, best sort of tax related, you know, alpha generating tools that we've had available. So, you know, one thing we're focused on is how do we think about, you know, wealth transfer to the next generation in a tax effective way through real estate or not. The other ideas that we're exploring in general is, you know, are there businesses that we can launch related to this type of tax characteristics, especially in light of some of the access to real estate has been reducing, you know, almost as a secular trend, starting with the REITs being bought out by larger private equity groups, all the way to Starwood and Blackstone's, you know, their non-traded REIT vehicles gobbling up access and now sort of sending capital back to the market. A lot of the, especially tax sensitive investors, family offices, their access to real estate has been reducing. So we think that there might be a secular trend there where we can help, you know, spur some businesses. An example for us is we did launch a series of qualified opportunity zone funds in the past 2-3 years, where we've anchored it with our own capital, because it's what we would have done, but also led our friends and family in investing in multifamily projects, mostly in the Sun Belt, sort of West Coast, Mountain West regions. Outside of that, the way we're viewing real estate is really on two barbell strategies. One barbell is very short term or very long term. Very short term is that so that we don't want to be caught in that massive volatility. Very long term is, you know, we can withstand the volatility with having a very long term view. So on the short term, as Ross mentioned, there's some private credit, you know, short term lending type of opportunities, or going in and flipping or providing rescue capital in the short term type of play. In the long run, we're looking at alternative asset classes like farmlands. For example, citrus farming in Central Florida, right? Or looking at, you know, crop farms in the West Coast. So these are stuff that we think we can hold on to for 30, 40, 50 years. And on the other side of the barbell, we're thinking about either very, very high risk, high reward, or very low risk, low reward, almost emphasizing the tax benefit aspect. So on the low risk, low reward could be, say buying a land that we can sit on, or a parking lot, self-storage type of, anti-cyclical or non-cyclical type of asset that are inflation protected. On the higher risk, higher reward, that's sort of harder to come by in real estate on a relative value. We're not seeing as much at this moment yet.
And the highest risk reward on that side tends to be development oriented.
It could be ground up development, but what we are really looking for is price dislocation as opposed to pure distress. We're seeing some distress from distressed owners and sellers, but we're not seeing the price dislocation as much yet.
What do you think
Jiho,
it will
what-
take? Go ahead, Sam.
Oh, sorry,
Go
Jiho,
ahead.
could you share your allocation to real estate overall relative to the entire portfolio?
So we still have more than 50% in real estate, partially because we have our operating real estate business. But if we take away the operating real estate business, it's really, less than 20% in real estate. 80% are more in the liquid positions, mostly fixed income, actually.
Gotcha. And has that changed over the last few years?
So we've been actively moving, basically reducing our concentration from the operating business. So we're still kind of in that process from moving all of our concentration from real estate into other asset classes.
That's interesting.
So what do you guys think?
What are the asset classes you're moving to?
Yeah, so it really has mostly been in, fixed income, so treasuries, corporate credit, muni bonds. On the equity side, we were actually doing tax loss harvesting strategies. So we're not being a hedge fund as much, but rather, utilizing the public market, just getting a beta exposure, but adding tax loss harvesting strategy on top of it. So creating something like 200 to 400 basis points of tax alpha every year. So just following the beta plus that really gives us a solid return. So those are really mostly what we've been focused on. We have been investing in some venture, private equity, other stuff as well.
And there's no doubt that high yielding kind of liquid assets that family offices and other investors can take advantage of, whether it's fixed income, money market funds that are close to 5%, CDs that are over 5%, to probably 5.25 to 5.40 right now, are all making an impact in terms of what entrepreneurs like Dino or myself or San that look to raise capital are up against, because your returns have to be compelling above those rate of returns, because you could take those, sit in those assets for a while with little to no risk. And that changes the whole capital allocation dynamic.
I think a lot of the startups with a short-term perspective on things are going to be in trouble over the next few years for that same reason. But as long as you have a long-term conviction and thesis, you're probably going to come out stronger.
And staying power.
But yeah, I hear your point. It seems like all the major LPs and pretty much large percentage of the LP partners we're speaking with on a daily basis, they're sitting on the sidelines waiting for things to normalize or start seeing the lights at the end of the tunnel. And it feels like the investment managers and allocators are getting paid for not taking risk nowadays.
What do you call normalized?
I think once we get a little bit more clarity from the Fed, where interest rates are heading. I mean, now everyone kind of feels that we're probably looking at another 2 hikes by the end of the year.
So normalized use running at about 4 or 5% interest rate.
We think so. We think that the long-term normal is probably around 5.
So what is it with business, real estate business? What do you look for? You want to get there? Let's say next year.
In terms of yield?
Yep.
I think there's rooms for deals to pencil out in the mid-high teens still.
Really depends on the kind of capital that you have. I mean, like I said, the examples I gave earlier, where some of the big, Prologis, which is like the biggest industrial owner in the world, can afford to pay a 4 cap. What's that?
They're very good friends of mine. So,
But also,
Hope you invested with them.
it sounds like Fred has a different concept of what is going to be normalized.
yeah.
No, you should tell us.
Yeah.
Well, I don't know if you look back in the history of rates versus stock market versus real estate market. Stabilization happens, you have to assume 4 or 5% interest rate. That environment, you're gonna look for it. And property doesn't give you that, or whatever assets. And you really have to take bigger risk, much better understanding of what you're buying. And then it works out very well. You know, and we have some of the best offerings of any kind, any assets in those years. So, and they're also building it. They keep building, you know, in a very normalized, slow, steady basis. And then you get some zero interest rate environment again. I hope you don't.
Well, 0% is certainly not normalized. Although, you know, you have to look at, you know, from the US government perspective, there was a big incentive to keep rates low, like 0% forever, because of the cost to finance, you know, the debt and the deficits that it takes, because those higher normalized rates, you know, mean huge increases in terms of what the government has to pay, you know, to service the debt.
Well, I don't think that that's smart. They just made a mistake all along. It's the same people.
I'm not arguing with you on that.
So you give too much credit. They always screw up.
Well, another way to put it is that it worked until they broke things, right?
I can't believe it. I can't believe it. They're giving them credit.
But you know what the problem is, that everyone's brain got wired all these years with certain expectations as far as returns and what deals should underwrite to and should not, that now you're looking at opportunities and suddenly nothing makes sense and everyone's sitting on the sidelines, right?
So what do you guys think about the fragmented nature of some of these commercial real estate investments? You guys did a great job distinguishing yourself from the crowd, having a nuanced business in a very tough market where transactions are just difficult to come by, right? I'm sure there's some trick up, although just to see if you get that one. Right?
Hey, Ross.
Right? They could buy
Yeah.
bonds at 80 cents.
It's tough to hear. Could you repeat the statement of question just so we can hear? It's tough to hear from here.
I would say, you know, about some of the like the crowdfunding platforms and all these bad deals that got done for a decade, they've got to be in the billions, right? How do you see those things ever repricing or going away? Or how many real estate online platforms are there? They've got to be like 10, 15, 20, I don't know.
Sam, the question is, you know, there's all this.
What are all those investments
You
got?
heard it?
So
I heard. Yeah, thank you.
I could, yeah, I mean, really, of the myriads of crowdfunding platforms that popped up in the past 15 years, probably 3 survived, 3.5.
Yeah.
What the biggest winner, like clear winner, has been CrowdStreet, and they've actually still been raising at billion to 1.5 billion a year clip.
Right. I don't
What-
think they're doing it.
They actually, well, so their operating company, so I can share at least what I know, which I think I know. They're actually, you know, they're profitable, their business is profitable because they are a pure syndicator. They're a fee business, they're a placement agent. So their business is fine whether or not the deal's, I guess, outcome is really doing well or not. So far, because of their average vintage has been still pretty good. You know, they've still made investments many years ago that are maturing and doing well. And what's surprising to me so far has been, I was mostly worried about their capital call risks. If there's like a renovation need or, you know, refinance and you have to inject capital, how would all these like hundreds of investors on a deal respond to capital call? So far, their stated capital call response rate is higher than 95%. That's to be seen. That's because their initial model has really been, let's get $5,000, $1,000 from many, many investors. In reality, they were getting Facebook, Google, Uber executives who were sitting on, you know, 8 million of cash, throwing $100,000 a piece. So they're actually, their syndication wasn't really from the small investors, as the law initially that
Never really.
intended to, but
It's impossible.
If the past is any indication, and it probably would be different this time because it's more visible and more liquid. But I remember doing deals back in the late, in the 1990s, where, you had all these busted syndication deals, that Merrill Lynch did or Lehman Brothers did, not to point fingers at any particular bank. But all those syndications were very illiquid, and people, that invested in them, you wrote a $25,000 check, and you didn't know what you invested in. You got very little information, and you couldn't sell it. And eventually, a secondary market developed, and through the secondary market, even though it was very inefficient, people were able to get out of those deals. I mean, I was a buyer.
Ross, you're on this earth. I want to do that.
I wanted
It's
to
gotta
do
be
it.
billions.
It was a great. I could tell you stories about that.
so one of the big difference actually is that a lot of the crowdfunding platforms invested in minority stakes to begin with.
Yeah.
Which is, they're actually in for the ride along really sophisticated LPs. A lot of them.
Here's somebody who knows a lot about real estate. What do you think?
Earlier, I did not take your side 100%, but after lunch, I am. Great. Dino, you were talking about your project before. Can you tell us more about how are you able to deliver it below market? When we talked and you made a presentation to me earlier last week, I was intrigued by it. That's why I told you I'm coming to Tampa to take a look. So tell us more about it.
Yeah, thank you. There's a lot of innovation that's about to happen in the housing market in general, whether that's through tech or just streamlining your operations in general. And again, that's driven by all the pain points that we've all experienced over the past decade or so, right? With, again, going back to supply chain and labor shortage. So the way we're solving around that is we're keeping things very, very simple in the manufacturing line. We're building factories that are 25,000 square feet or less. We can put them up in less than 90 days for less than $2 million with basic equipment that we can pack up and put on the back of a truck and move it to a couple states down if we end up saturating a certain market. So our capex are very low and our flexibility is very high. We need about 12 people to operate on full capacity, the factory. And if we work around the clock, we can have 3 shifts, so we can deliver about 800 homes a year, right? That's just one factory without doing any third-party service. So by doing all that, we create economies of scale that we haven't really got the data yet to support that thesis, but we think that we're going to be achieving additional economies of scale by about 10 to 15% once we operate those factories at full scale, at full capacity. Right now, without those economies of scale, because we're minimizing all that waste and we're reducing the labor force so dramatically, we can be exactly competitive, directly competitive with a stick frame traditional housing. And the answer, the question is out there. How do you quantify? How you put a dollar sign after time, right? We all know time is money, but how you quantify that? We know that we can save about 1 to 2 months from the timing component when we build those communities compared to traditional. So add a dollar sign next to that, and then you see even more the return factor, kicking in. Obviously has an impact on the IRR, which is why we can deliver the high teens gross IRR, right? Because your cash flow kicks in a little bit sooner than the traditional. But at the end of the day, in our viewpoint, it's win-win because you deliver a project, a property, a home that's actually much better quality to the end tenant. It's better for the environment. Okay, it's better for the investor because it's long-term. You minimize your operating expenses.
You expect your insurance code will be less costly due to the use of this material?
Yes, we've actually spoke to large national and international underwriters about this, and the initial feedback that we got is that we're expecting even up to 25% reduction on insurance costs. because of the hurricane rating of the product and the way we build. So I think if you multiply that by whatever number of homes across a community and across the portfolio, that's significant savings, especially in an environment where today OpEx is a huge line item on everyone's books.
And you chose Florida
That's
due to
great.
any incentives?
I mean, there are incentives throughout different municipalities that we are betting on. We're very close with all major municipalities in the Southeast. And another project that we're actually rolling out, and the way we're building allows us to do so, we can move up and down the affordability spectrum. So we can build bare bones, minimum quality, but still very good housing, much better than a mobile home for like 1,000 square feet, workforce housing project. And we can also go crazy on the upper hand of the spectrum and deliver luxury housing at a very competitive rates. So with this product, it gives us the flexibility to attract the municipalities that want to build more workforce housing into their cities and towns.
Dino, what are you seeing? What are you seeing as price per door post discount on insurance?
On insurance?
Yeah.
Sorry, can you repeat
What
that?
are you seeing? Yeah. What are you seeing net of your discount on price per door for insurance for your project?
I mean, right now we're about $1,200 a year without any discounts. So the way we're underwriting our communities, we assume we're not going to get any savings. And even without the savings, we're still in the high teens. So we still want to continue underwriting like that. But based on the feedback, if you shave off, up to 25% of the 1,200, it's very significant and it adds up. So your NOI
that's fantastic.
Significant bump.
That's fantastic. I mean, for us on the ground, interest rates are a factor, but like the deal that we signed, we actually assuming an 8-year fixed loan at 5.2%. So there are deals out there where we can do loan assumptions. Insurance is actually harder for us because there's no escape.
I mean, we assume even on the construction side, our assumptions are very conservative. We assume 60% LTV at a 9% coupon. So, 400 or 500 basis points over SOFR, right? And then takeout is an agency loan, stabilization, 60% LTV. And that's still, it's like a 1.3 coverage ratio on the loan at a 6% coupon. So we're trying to leave a little bit of room for error, but still being conservative.
Yeah.
Are you getting a 6% coupon now, or is that what you're targeting?
That's on the back end, on the takeout. But on the front end, on the construction loan, the indication we get from different lenders is that we're going to be right about that 9% range.
We have about 5 minutes.
Anybody in this room here, anybody currently investing in real estate this year? Have you done any deals in any investments? Want to fess up? Nobody, no real estate investors?
Can you guys
Anybody?
talk about capital stack? I mean, I know, Jiho, you are a real, you represent a family office. And when you invest in different deals, do you consider who else is on the cap table with you?
Yeah, I mean, absolutely. As a family office, certainly relationship is very, very important. Probably much more so since we pay a premium to avoid headache.
Right.
So in our qualified opportunity zone investing, actually, we ended up partnering up with other large family offices, going in together, alongside with shared control, or even us giving up control to that party if they're a larger investor. So certainly we've done that on the equity side. On the debt side, that's even more pronounced because you do want to have a more of a consortium of lending relationship.
What about the mezz? Is there opportunity in mezz? By the way, love your idea about the relative value bonds, no brainer, buy at 80 cents. But what about mezz pieces? See, your leverage is lower, right?
Yeah,
If your leverage is lower, isn't there opportunity to come into a mezz at 15 or something?
So for multifamily, because the agencies don't allow mezz, a lot of folks are going in on the pref equity piece. So
Yes.
that's happening. And as Ross sort of alluded to, a lot of groups are kind of approaching the mezz and pref space. My current view is that a lot of the borrowers right now should not be borrowing me, or as lenders, the people who want to borrow money from me today are the ones I don't want to lend to.
It's always the case.
I get that question a lot.
So in that, on paper, I think it looks nice. And when I talk about the barbell strategy, I either want to be very short term, very long term. These type of pref or mezz deals, I underwrite as a short term deal. In reality, it likely will have many, many rounds of forbearance, maybe even bankruptcy. You know,
No want to deal with it.
not necessarily.
Yeah,
I used to have interest in doing mezz deals, but as an owner, I don't want to at all. And as a lender, it's too much headache.
well, the 60 LTV, there's room for mezz, right? That's a,
If you want to, yeah.
Yeah, there
Yeah.
is, if you need the proceeds, yeah.
Yeah, I mean, there's a lot of issues with, again, getting back to the capital stack.
Can I?
I think a lot of people really loaded up on leverage in the last 10 to 15 years, like beyond. And then I think that a lot of these consortiums came to be where everybody was investing 5%, 2%, and then when you need to re-up for leverage, it's not so straightforward who's actually controlling it, right? And with a lot of these like consortiums that came out of Texas, for example, which I think that's a huge trend with Texas and these massive consortiums. I guess there was a Obama law that passed in 2014, which made it easier to invest in consortiums, right? So any thoughts on that in terms of, I mean, there's a whole series on the Wall Street Journal about this consortium investing.
I mean, I think a bigger trigger is that if, as you said, when the refinancings come up,
Yeah.
are lenders forced to force the issue? In 2020, they weren't, right? We passed a law to SEC and FDIC, everybody said, it's fine, just kick the can down the road. And in a way, it was a response to back in 09, 010, 11, banks did take action, which led to a bigger catastrophe. Maybe that's the right thing to do or not, who knows? But the point is, right now, all the lenders are just kicking the can down the road. And are there going to be a forced issue? And I think a lot of that will be a regulatory type of action driven.
Well, the other thing too, that might force the issue is so far while the economy has had a lot of shocks over the past few years, we haven't had the big employment shock. And if employment, craters and the consumer craters, then you're going to have real problems across a lot of different asset classes.
Right, personal income has dramatically trailed inflation though, right? So, I mean, so that's, it's it's all kind of laboring for,
So
right?
baked in, is that?
But I guess, so the question is, how long can you extend? Because the difference between 2008 and today is that the Fed was able to reduce rates, and that's not happening now. So.
Well, it's more, do Fed require the banks to shore up capital? Like if there's a credit crunch, I mean, they should, right? But would they? Because again, if you look at April of 2020, if you recall, all the banks had this free pass. Hey, I know your DSCR coverage that it was all failing, but we're going to let you just pretend it's not happening.
I actually want to take a vote of the audience here. Who here thinks that the Fed in the next year will make banks get more equity, raise more capital for equity? Anybody?
You too.
You do, really?
Yeah.
You think it'd be forced mergers?
Well, that's what's happening now. There's a lot of mergers among community banks. That's happening right now.
Banks are
Someone-
volunteering, yeah.
Someone mentioned the M&A, was it you that you mentioned the M&A, correct? That's what I agreed with.
okay.
Maybe you can restate what you said.
What about what happened in Switzerland? You see they did the Credit Suisse and all
Half the employees have been
all those
canned.
guys. Regulatory risk is the worst risk, right? I mean, if you're an investor. They changed the rules on all those guys buying those bonds if they force them to buy in the first place to capitalize the banks when they were all bankrupt to begin with. After they issued it, what were those convertible bonds called? The Deutsche Bank had to do, and all these others that had no money. They had no tier 1 capital, and then they wrote them off to zero. So you got to watch out.
I think the lead
They
bank,
come in there and they start rewriting the rules. Ooh.
wasn't the lead bank in Spain reconstituted like 3 times in 10 years, right? Based on the same principle.
You could lose a lot of money there, I think. Personally, I was in Bangkok because I know we
So
were
don't
right
bother
from Thailand,
banks.
but
So,
they just reinvent the rules.
So
So
this
you're,
is
you're,
interesting.
you're out, you're in, you're.
and I'll tell you why it's interesting. Because about 12 years ago, we sat in the, actually, we were at Harry Feinstein.
Yeah.
And we raised our hands and said, who here thinks there's gonna be a raise? Who thinks we're gonna raise the federal raise rates? And like everybody said, yes, the federal raise rates in the next 9 months. And then the question was, who thinks the federal raise rates by more than, 50 basis points? And nobody raised their hands.
Oh, wow.
So that's,
I remember
so then the question is, what's the intervention gonna be in this, upcoming bank equity?
Well, it's more like this, underlying assumption is that banks will be required to post up equity, right? That's why they are voluntarily going with doing mergers, not issuing more loans, et cetera. My point is, there might be an exception. That'll all be kind of a boon to the real estate world, relatively speaking, but will continue to kick the problem down the road.
But I think the general sense on the lending side is that there is capital available, right? But as we on the equity world, same with the banks, they're betting on quality rather than quantity. So the underwriting criteria are way stricter. And what I mean by that, they're betting for projects that are well located, have great cash flow, as credit as possible, and multiple exits, right? I think that's key, because one thing that we all found out over the past few years is that you can easily get caught on the wrong side of the market, and then there's no exit. So what do you do there? The answer is you give back the keys, as many of the most reputable owners in New York City even ended up doing.
So you give back your keys to the bank.
Yeah.
And what does the bank do with the asset?
That's exactly the question, right? So that's when you're gonna start saying it loud on the streets.
Oh, the banks,
That's the.
When Russia deconstituted the USSR, everybody got shares in all the state companies, right? And then these oligarchs came in and got finances from England, and they bought all of the shares for 10 cents on the dollar. And that's how the oligarchs are created, right? So it's interesting how things happen. So I think we got to move on to the next group. But this is a great panel. So thanks so much, guys.
Great job.
Oh, do you want me to go?
thanks.
Yeah,
for
we
being
need
here.
So it sounds like